Markets on Wall Street and around the world are in a mini panic.
It's getting ugly real fast out there.
Worried about a slowing U.S. economy, investors sent the market in Japan to its worst day in decades and have sliced billions in market value off some of the world's biggest technology companies. They've turned a relatively calm year in markets on its head. What are the possible causes of this sudden market shake-off?
The volatility index, or the fear gauge, which is a measure of how afraid investors are right now, it's at a 65. And just to put that in perspective, if we go back to March of 2020, when the pandemic was full swing and people were locked up in their houses, it was 53. It's 65 right now. You go back to March of 2009 when we had the banking crisis, it was 44. We're at a 65 right now. Investors are incredibly scared. And I have to tell you, this cannot just be due to Friday's payroll report, because on Friday, the market was down about 2%. So there's more going on than just that.
For most of the year, investors worldwide drove stock markets higher, convinced that central banks were successfully, if haltingly, getting inflation under control, and buoyed by a healthy U.S. economy and the promise of artificial intelligence. That confidence has taken a hit the past few days.
Two issues are: number one, Warren Buffett unloaded half of his Apple position. That's a guy who's buy and hold forever. All of a sudden, he's, maybe he doesn't have a high conviction on Apple going forward. And then obviously the increasing probability of a full-scale war in the Middle East. You put those three things together, and it's an ugly situation in the markets.
Weak readings on the job market, manufacturing, and construction last week sparked worries about a U.S. economic slowdown and criticism that the Federal Reserve waited too long to cut rates. Meanwhile, the Bank of Japan raised rates, causing turmoil in Japan's markets. On Monday, the Nikkei plunged more than 12%, its worst drop since 1987. Investors are now listening to warnings that Apple, Nvidia, and other big tech stocks have gotten too expensive. On Friday, the tech-heavy Nasdaq Composite went into a correction, which is a 10% decline from its most recent high. The heaviest selling has been in small companies that make most, if not all, their sales and profits in the U.S. Prices for oil and other commodities fell because of the economic worries. Investors thought the Fed and other central banks were on track, even though inflation remained somewhat above their targets. The European Central Bank and the Bank of England cut rates once, and the Fed signaled it was prepared to start cutting rates in September. Despite some signs of cooling, the U.S. economy kept chugging along even with higher rates, outpacing Europe and Asia. Then came last week's economic reports. Weak reports on manufacturing and construction were followed by the government's monthly report on the job market, which showed a significant slowdown in hiring by U.S. employers. Worries that the Fed may have kept the brakes on the economy too long spread through the markets. The global financial crisis is far from over, according to analysis by a major Wall Street bank, as European markets continue to decline. Analysts at J.P. Morgan have highlighted concerns about carry trades, which are believed to be a key factor in the recent market turmoil. Carry trade occurs when investors borrow money from a country with low interest rates and a relatively weak currency like Japan, and invest those funds in places that will yield a high return. The higher interest rates, plus a stronger Japanese yen, may have forced investors to sell stocks to repay those loans. Following the Bank of Japan's decision to raise interest rates for only the second time in 17 years last week, traders have started unwinding these trades. As a result, there has been a scramble to sell higher-risk, dollar-denominated assets to manage the increased borrowing costs, losses from exchange rate fluctuations, and falling asset values as share prices dropped. Arindam Sandilya, co-head of global FX strategy at J.P. Morgan, told Bloomberg TV, "We are not done by any stretch." So, should you sell your Bitcoin now? As of 4 p.m. Monday, the price of the world's largest cryptocurrency was just above $54,000, down from nearly $68,000 1 week ago. Greg McBride, financial analyst for Bankrate, points out that a 10% pullback in markets happens on average once every 12 months. The S&P 500 is down about 8.5% from its recent high. Chris Zaccarelli, Chief Investment Officer for Independent Advisor Alliance, says investors should wait to see how the recent turbulence plays out.